Good afternoon and welcome to our webinar on carbon removals. My name is Andy Houston and I'm going to be hosting the discussion today. So this is a really exciting area for us and one in which we're starting to see a serious level of interest from our clients, but it's also one in which levels of uncertainty are pretty high. So hopefully we can unpick some of that complexity today. So Mostyn, if you could just flip to the disclaimer slide, please. I will ask everybody to read this at your leisure and then on to the next slide again, please. So our main presenter today will be Mostyn, who's our expert in this area, and he's going to take you through the material. Please do ask questions through the GoToWebinar software. Just type them into the box at the side, and then we'll come to some of those at the end, depending on how much time we've got. And just a housekeeping point: slide pack and a recording will be made available after this, and we'll mail them out to everybody. So I think with that, I'll hand over to you, Mostyn, to go through the material.
Thanks, Andy. And just by way of introduction, my background is in science. I've got a PhD in biochemistry from the University of Oxford, followed by a postdoc in biophysics, and then have been with AFRY for over 10 years, modelling energy markets and focusing on leading the modelling of the EU ETS carbon market and also the voluntary offset market. And I've had the privilege of working with some of the key buyers, sellers, movers and shakers in this market to date. So to set the scene, the removals market, although is very small, is expected to take off imminently and is getting a lot of attention. And there's a couple of reasons for that. So firstly, we're looking at the prices here that removal credits are getting. If we contrast that with the traditional offset prices, emission reductions typically trade around the $6 a ton mark, and there's a real differential between removals, whether that's temporary removals around the $15 a ton mark, or permanent removals around the $500 a ton mark. We'll go into what we mean by permanent and temporary removals in the course of the presentation. But the key message is that there's a really large premium for removals. And the second indicator that this market is gaining a lot of attention is the amount of investment that's actually going into it. So here we're just showing the amount of investment that has gone into the market just through private investment and only in permanent removals, reaching over $1 billion in 2022. And that the important thing of that is that it was more than doubling from the 2021 levels, and we're expecting that kind of ramp up rate to continue. So in this webinar, we're going to be asking the questions of how will this market develop? How will prices develop? Which volumes will come online? Which technologies? How will the demand evolve? And how will it be split by different geographies and so on? And we're going to be answering those questions in 3 stages. Firstly, we're going to outline why removals have got such a critical role to play in the route to net zero. Then we're going to talk about the recent market trends and how the market is developing. And then we'll come on to AFRY's modelling of a subset of this market, so looking at the voluntary permanent removals market, before summarising and coming on to some Q&A. So we want to start with the role of removals and wanted to start with a really big picture. And this should be familiar to many of you, that we're on track for a 1.5 degree warming, or well beyond that at current trajectories. And these are the numbers that are coming out of the IPCC. So as we know, the level of warming that will be committed is proportional to the cumulative carbon that's released into the atmosphere. And currently, the unfortunate news is that the existing and planned fossil fuel infrastructure emissions stand at 850 gigatons that will be released. And if we contrast that to the budget for staying in under 1.5 degrees, is more like 510 gigatons. So we're set to burst through that threshold, and that has obviously rather important consequences. I'm not a fan of the use of global warming, because it doesn't really capture the extremes, and it's the extreme weather that's going to be impacting society. If we think about current migration, it's estimated that over 20 million people are displaced by extreme weather each year. That could go into the billions if we're on trajectories for well over 2 degrees. And that's a frightening thought, not just for society, but of course for the underlying economics as well. If we look at how to turn this situation around, we all know the story. We have to bend this emission trajectory down very, very sharply, but that's not enough in itself. So all of the 500 or so scenarios that the IPCC have modeled all require an element of removals in those targets to stabilize temperatures once we get to net zero. And so here we're plotting the blue line is the net zero, the net emissions here, and what's clear is that we're not only going to have deep emission reductions, but in parallel we need to ramp up the removals sector. And if we do end up breaching these upper temperature thresholds, then the whole global economy is also going to have to go net negative to try and reverse some of that warming impact, albeit that's hopefully a long way in the future. So I wanted to just describe the different nature of these two different segments. If we think about the limiting current emissions, this is focused on emission reductions. So most conventional offsets or compliance markets traditionally deal with how to reduce emissions, and effectively it works by paying someone else to reduce or avoid emissions. So in this little example here, instead of collectively emitting 2 tons through a cap and trade scheme or through the conventional offset market, by paying someone else to avoid the emissions, we could only result in, say, 1 ton of emissions instead of 2 tons. So that's a positive contribution, but the net result is still positive. We need removals because we need to actually take atmospheric CO2 out of the atmosphere and store it durably, and only that net negative component can be counted as a carbon removal. If we think about the different technologies that deliver these types of emission reduction or removals, on the emission reduction side, they fall under things like energy efficiency and renewables and so on, but also CCS. And this comes into some of the confusion around CCS and carbon removal. So CCS is not carbon removal because it's taking fossil CO2 instead of atmospheric CO2, and that process can never be fully net negative. And therefore is not cost of removal. In turn, the removals can be grouped into 2 different technologies, temporary removals and permanent removals, and we'll come into the underlying technologies of those in the next slide. So here we're defining these 2 types of buckets of technologies in relation to the durability of their storage. So here we're taking some inspiration from the EU's certification framework for carbon removals and defining temporary removals as anything that stores carbon for less than several centuries. So I guess that means less than 200 years under that parlance. Now, there's lots of different technologies that can deliver that temporary removal. They tend to be nature-based focused solutions, so things like reforestation, habitat restoration, where it's both the capture of the CO2 that happens in a biogenic setting, but it's also the storage as in the biosphere as well. And that means that you can't guarantee that that carbon is going to be locked up in the biosphere for a long time. In contrast, if we look at the more durable removals, these typically require some kind of technological intervention in addition to the capture. So in the case of direct air capture with CCS, it's an entirely sort of synthetic, man-made approach. We're taking reactive sorbent material to bind the CO2, and then a very energy-intensive process to then strip the carbon from that sorbent and store it underground. In the case of BECCS, we're taking carbon that's been biogenically sequestered through photosynthesis, burning the biomass, capturing the CO2 and burying that in geological formations. And other forms of biomass carbon removal and storage are possible, for instance, in the process of producing biochar, or indeed woody biomass burial, or other kind of bio-oil techniques, all using photosynthesis to capture the initial carbon, but then trying to put that into a very durably stored technology to keep it locked away from the atmosphere. Next, we've got enhanced weathering, where you're breaking up silicate rocks and increasing the surface area to enhance the natural process, enhance the weathering and the binding of CO2 to those rocks. And finally, we could also envisage scenarios where concrete is used to actually bind atmospheric CO2. So those are some of the technologies that are capable of delivering both temporary and permanent removals, and we're seeing lots of innovation in this space and more technologies and more ideas coming online all the time. Next, we're going to think about the relative volumes of the different contributions in the different voluntary market to date. So if we think of the market covering the big four registries at the moment, 90% or so of the offsets that are retired belong to the domain of emission reduction. So those are things like energy efficiency and renewable energy and so on. The remaining 10% can be ascribed to removals, but virtually all of that 10% is in the form of the nature-based temporary removals. And only about 0.2% of that 10% is actually dedicated to permanent removals. And in this webinar, we're going to be focusing on permanent removals. And so I guess in that context, it's worth asking the question, why are we focusing on permanent removals and not the other sectors? So firstly, on the emissions reduction offsets that have occurred to date, they've been used to support some claims made by corporates or even some governments that do not stand up to scrutiny effectively. And now what we're seeing is a real backlash against that. And actually a lot of these firms are now being sued for effectively greenwashing. So that's one reason to focus on removals, which tries to differentiate itself from the conventional offset market to date. The other reason is that we're expecting a massive growth in the removals rollout. So as we saw in that early graph about the volume of removals required, this is taken from the IPC numbers. So we need about 4 gigatons of removal by 2030 and more like 5 to 10 gigatons by 2050 to be on track for sensible levels of warming. And that's a massive increase from today's values. And so temporary removals has a massive role in that. So at least 50% of this volume would be through temporary removals. But the reason that we're focused on permanent removals in this webinar is based on the science, a lot of it coming out of Oxford University, who really sees a role for geological removals to neutralize fossil emissions rather than using temporary removals. And that has then been sort of transmitted around through quasi-government organizations like the CCC, and also voluntary standards like the Science Based Targets Initiative, all the way to the UN's high-level commission on net zero. So all are saying that permanent removals in particular has a key role in neutralizing fossil emissions. So hopefully now we've set the scene and described why removals have such a critical role. Next, we're going to look at some of the recent market trends and how the market is developing. So a lot of you will have seen that there's been a lot of activity and a lot of exciting statements that have come out from leading organizations. They tend to be banks, technology providers, and so on. And they tend to have very ambitious net zero targets. And they've gone out to the market and said, we want to procure a set volume of removals at a set price, and really stimulating this market, and they're prepared to pay exceedingly high prices for that service. So these are just some of the different entities that disclose the price of their transactions to date. And a lot of them are over the $1,000 a ton mark. So really quite eye-watering levels, even though volumes are really quite small. And the reasons that they're doing this is all dependent on stakeholder values and what stakeholders think are important. But nonetheless, when evaluating the different projects, they all share a common desire to have to purchase high quality removals. So it's collectively, these organizations at the forefront do not have a common rule book for assessing that quality, but they tend to share some key characteristics. So typically they're looking for assessing durability. So how long is that carbon stored out of the atmosphere? And that's an important characteristic because it's directly proportional to the climate effectiveness of that removal. Then we've got additionality. So would this project have happened without the contribution of the voluntary market coming in there? That's an important consideration, particularly with the expansion of compliance markets. Then we've got all the rules around carbon accounting and monitoring, reporting and verification. So where is the carbon stored and what are the different energy balances assumed in the calculations there? And finally, about sustainability and making sure that this intervention doesn't have adverse impacts on local communities or knock-on impacts. And in particular, for the biogenic type of technologies, the sustainability sourcing of biomass is particularly important. So with that in mind, even though these types of criteria are used to assess individual projects, what we can see is trends in pricing occurring in different technologies. So again, if we look at this data set of known price transactions, we can see that DAX technologies in the middle there seems to attract extremely high prices, so in the region of $1,000 a ton. Meanwhile, some of the biogenic removals, the biochars and novel ways of sequestering biogenic emissions without using BECCS per se can deliver much cheaper removal costs there. And if we look at on the volume side, corporates have purchased about a bit over 4 million tons of removal so far. Of that, only about 100,000 has actually been delivered, so around the 2.5% mark. And of that delivered volume, it tends to be the biomass-related technologies, particularly the biochar and bio-oil technologies that have really that are available right now. And going forward, the contracted pipeline in the near term is dominated by BECCS, so bioenergy with CCS. So far we've talked a lot about the supply and demand for removals, but I also wanted to bring up this slide, which is borrowed from Puro Earth, to illustrate what's happening in the middle ground as well. So there's lots of activity to bring the supply and demand side together, and some of that is common to any marketplace. So the existence of brokers and exchanges and so on. But a lot of this infrastructure in the removals market is dedicated to ensuring that trust and transparency is brought to this market. And we're still in the very much expansion stage of that process. So new players coming out, new registries appearing all the time, new ways of doing verification and so on. So it's kind of exciting time, and we're still in the expansion stage. But I wanted to zoom in here on one role, on the role of governments and what role they have in facilitating this market. So far we've just talked about the voluntary sector, but if we look at the targets specified by different leading countries around the world, start with the US, that's got a target of 1,400 million tons to be sequestered per year by 2050. It's a very ambitious target, but they are putting their money where their mouth is. So the US has been extremely influential through the Inflation Reduction Act to incentivize the deployment of the leading permanent removals. And that's through tax credits and so on, which means DACs can now get $180 a ton for providing DACs. BECs can get up to $85 a ton. And now the US government is also saying that it will also directly procure removals as well, which is quite an exciting development. If we look at the UK, different approach. The UK has a UK ETS, so that forces large industrials to reduce their emissions over time. And what the UK government has said is that they will integrate technological removals into the UK ETS. And in addition to that, they're saying that the carbon price alone is probably not going to be able to support that, the rollout of those renewables. We're also going to see have to see some price support, perhaps in the form of carbon CFD. So watch this space for that. And finally, if we look at Europe, which is, I'd say, kind of lagging behind the other sectors right now, it's got a target of 5 million tons per year for permanent removals. It doesn't even have a 2050 target right now, which it needs to establish. And it's gone through the process of establishing a quite extensive certification framework instead of getting onto the actual incentivizing deployment just yet. But we thought we would explore what that might look like. So in our modeling, when we're looking at the EU ETS, under current legislation, the cap under the ETS would fall to 0, so 100% decarbonisation by 2039 if current legislation didn't change, which is not going to be a tenable solution. In our modelling, we're assuming that the cap gets to net 0 by 2050, and we're assuming that removals could be integrated into the ETS, or at least permanent removals could be integrated in the ETS. And so when we run this through our ether carbon modelling, which looks at the ETS and looks at the least cost way of achieving that decarbonisation target, we come out with a figure of about 200 million tonnes, which would be required to neutralise those fossil emissions. Now, that's just in the EU ETS, so that doesn't account for the other sectors beyond that just yet. So that's kind of lower end of what's probably going to be required. And I just end on this slide thinking about the way that governments incentivize the deployment of removals is going to be critical in the role the voluntary carbon market plays alongside it. So we take the line that if a removal is fully integrated in an ETS, i.e. there's an obligation on buyers to procure that removal, there is no scope for the voluntary carbon market to play a role in that because the additionality argument falls away. However, if we take the case of the Inflation Reduction Act in the US, then there can be some symbiosis there where the public money can help drive some investment and so on, but there's still space for the voluntary market, for voluntary contributions to make those projects economic. So that's an important acknowledgement, and you need to understand those dynamics to understand how the voluntary market will evolve. So that brings us on to how we do our modelling at AFRY. And the spoiler alert here is that we're not going to be able to provide any price projections or the volume outlook, but we do have that available to purchase if you're interested. What we'll do instead is just run through the techniques and assumptions we're using to model this market. So this is just an overview of the voluntary permanent removals market model. We've called it LPIS, and what it does is it looks at the various supply of removals, contrast that with the demand for removals, and comes out with different supply curves and demand curves. We can see the prices and volumes for the permanent removals, which technologies and demand segments are setting the various prices and volumes, and go down to the regional jurisdiction as well. So you can see which regions are most important from a supply and demand perspective. And finally, interrogate the model through sensitivity analysis as well. So all these are important aspects to help understand the risks and possible outcomes of the market. If we just go down into a bit more detail as to how the model works, there's kind of three key parameters. On supply, we are modeling 5 different technology buckets. So these are the technologies that we introduced you to at the start of the webinar. And we're modeling that over 5 different regions. So North America all the way through to Asia and Oceania. That gives us 25 tranches for the supply side. On the demand side, we're breaking this market up into 5 classes of demand. We'll go on to how we do that in the next couple of slides. But the way to think about this is you've got innovators who are right at the top of the tree, the Microsofts and so on, all the way through to corporates that don't even report their emissions currently. And we apply different prices and volumes associated with those different sectors. The final aspect of the modeling is the flexibility to change the assumptions and create further scenarios. So if we start with the drilling down a little bit more on the supply side, how does this work? So our starting point here is to look at the short-term named capacity build out. So that's typically dominated by BECCS and DACS plants. And really that's only to 2030 or so. We don't have very much visibility beyond that. But what we do is we go from that baseline of named projects up to the potential supply from academic studies out to 2050 and out to 2060. And one thing we have to be mindful of is, of course, the competing uses of biomass. And so we're careful to constrain the availability of biomass to that's deemed only sustainable biomass. But the numbers here look pretty healthy. We can get into the gigaton scale, so over 4 gigatons per year. But of course, the crucial thing is at what cost? And our approach to the cost side is to take assumptions from the kind of projects that we've been working on. We've got engineers across all these different technologies, and we add up our CapEx assumptions, look at OpEx and particularly the cost of energy, the cost of CO2 transport and sales, and the transaction costs to give a total volume of on the cost side. We then contrast that with the revenues. So how much can be expected from outside the carbon market? So potentially through the sale of electricity in the case of BECCS, or concrete in the case of carbon negative concrete and so on. We add in assumed levels of subsidies because that is effectively a revenue stream here. And we calculate the missing money that is required to make this project economic. And it's that missing money that we are using to define the carbon removal credit price. So in this example, only projects that can meet can provide a net present value that's positive, will get built, and it's that missing money that is crucial there. Next, if we look on the demand side, here we're using an index, our own AFRY's Climate Action Index, to segregate the demand segments. So there's lots of different components to this, but the main key criteria is this target ambition score. So here we're looking at we're rating all the different companies' target ambition. So do they have a net zero target? What year is that? And does it cover all scopes and so on? But it's easy to set a target. The crucial thing is, do you actually have the ability to follow through and fulfill that target? And we're using another metric here, which is the clean revenue intensity. So this is how clean is your business model effectively? How much revenue do you get per ton of emissions? And what we're doing here is each dot represents its own company. And what we can do is marry the data set of those that have already disclosed that they've bought permanent removals onto this. So these are the large bubbles shown here, and they tend to cluster in the top right corner. which affirms our assumption that these are in fact the leaders. So we define that top right quadrant as the innovators. One down from that would be leaders, and so on. And so we segregate the market like this, all the way through to, so laggards might not have a target set at all, unreported don't even bother to report their emissions, therefore are going to have a very low propensity to procure removals. So the innovators, we take inspiration from current prices to dictate their propensity to buy removals. Laggards, we're assuming they will continue with the current emission avoidance type levels, so not sufficient to really buy permanent removals over time. But we also expect some migration over time to move up this climate escalator, if you like. So we're expecting corporates to start reporting their emissions. We're expecting laggards to start setting their own net zero targets and so on. So it's a dynamic kind of outlook. And then on the volume side, we've got to, of course, consider the global decarbonisation policies. We've got to consider which sectors decarbonise at which different rates and so on. And the volume that ultimately gives us the volume of residual emissions that would need to be neutralised. And then comes the question, is that neutralised through temporary removals or permanent removals? So lots of assumptions around that. We flex those assumptions across 3 different scenarios. So we've got high, central, low here, and the key drivers are outlined above. So these typically fall under the supply, in the case of volume, regulatory outlook and costs. And then on the demand, the rate of decarbonisation, the level of corporate ambition, and how much the permanent removals market covers the total market. So all those go into our modelling. We're also capable of obviously producing bespoke scenarios as well, and we'll come on to that in a minute. As I said, we're not able to reveal the absolute price projections of these, so we can just give some high-level messages from this. On the price side, the general outlook is that in the short term, the prices are going to be really highly volatile because there's very little supply going around. We think that will unwind. We think that at the moment there's a fair bit of demand that's unserved, hence having to buy into the future, and that over time prices will come down from current levels as that supply starts to unwind. In the long term, we're anticipating that prices will fall as deployment ramps up, as we've seen with other technologies. And indeed, we're applying different rates of cost reduction to different technologies in line with how modular they are and so on and so forth. So that's on the price side. On the volume side, we're anticipating a really rapid increase in volume. So this is our markets modelling is showing the cleared volumes here. And we think that the supply is going to have to ramp up considerably to meet demand in the short term, so up to 2030, and that will continue throughout the curve, so both supply and demand increasing throughout all the way to 2060. And that's only tempered by the role of compliance markets that are kind of acting as a bit of a pressure valve, taking out some of that supply into the compliance markets themselves. If we focus on a particular year, we can see the different merit order curves, so the different technologies that we envisage could supply that total volume of removal. And one of our assumptions here is that over time, the market for permanent removals will become commoditized, and so that one can actually compare different technologies in the same bucket with one another. And therefore, in our pricing modeling, we're assuming that the price is set by the marginal cost of the marginal removal source to meet that demand. The The final aspect that I want to discuss in our modeling is the way that we can flex this model around different types of parameters. So some of the really important drivers that are going to dictate the prices and volumes in this market include the regulatory outlook, so whether different technologies are included into compliance markets at different times. We can flex that assumption. We can look at different decarbonisation rates and different rules around the volume of residual emissions that would be allowed to be neutralised through removals. Similarly, we can play with the different ratios of how many would be expected to be neutralised through temporary removals versus permanent removals and so on, as well as playing with the dynamics on the demand side as to how fast corporates will start stepping up their ambition, and including whether scope 3 is included or not, and also thinking about whether certain technologies will be cast out of the definition of permanent removals. So in the bottom case here, this is where we're considering that corporates would only consider geological removals as truly permanent removals in this case, and that would be strongly bullish to the market prices, at least, not for volumes, of course. So that was a quick run through how we do our modeling. Next, I just wanted to provide a bit of a summary before we go on to the next steps and the Q&A. So we know that we think that the permanent removals market is going to grow rapidly, but there are still lots of risks out there, and stakeholders will need guidance in order to answer these key questions. So some of the questions that will need answering around the supply-demand balance. So yeah, how will prices evolve as technology costs decline? And how will the volumes evolve as well? On the technologies, currently we're seeing a lot of interest in the biogenic CO2. Will that be sustained in the long term? To be decided. What about the more novel approaches to removal? How can proper verification of those novel techniques be achieved in order to ramp them up? And what impact will that have on the overall dynamics? How will the system change in terms of the geographies? So to date, we're really focused on the rollout in North America and Europe, but how will the rest of the world step up in their deployment? And finally, on the risks, we've talked a bit about the role of understanding both compliance markets and voluntary markets and the sort of symbiotic relationship there, but also potentially cannibalistic relationship. On the reputational side, there's also questions about how the rules around green claims and how they, what can really be used to justify a valid net zero target. And related to that is the role of temporary removals and whether they would, because they can be delivered at lower cost, would they undermine the demand for these more expensive permanent removals? So these sort of questions we feel like we're well placed to answer. We have a whole team of engineers and experts looking at all the different technologies in the removals market. And alongside that, alongside the development of our permanent removals voluntary market offering and price projections, we also have our compliance market pricing covering both the EU ETS, the WCI, REGI and China. And alongside that, a third model that looks at the question as to whether, if you've got your atmospheric CO2, is it more lucrative to put it into storage, i.e. through the removals market, or sell it as a physical commodity into synthetic fuels or other CCU applications? So if you would like to pursue any of those avenues, please reach out and register your interests. So we've put a QR code here if you'd like to scan it, or go onto the forms link. I think that's being circulated now. But also you can just reach us by emails. They'll be available at the end of this presentation. And I will pause there for any questions.
Great, thank you, Mostyn. Very interesting presentation. We'll get straight to some questions. So we've had quite a lot of questions. Some are quite detailed, and we'll perhaps come back to those individually. We'll drop emails to the people who have asked those detailed questions. But just going through some of the ones of more general interest. Obviously, this is a presentation on permanent removals, but there's a question here on temporary removals and what place do we see for temporary removals and how should we think about their value compared to the permanent removals side?
Yeah, that's the million-dollar question that's facing the industry right now. As I said, we know that temporary removals are going to be extremely important to meet the net zero targets, so they definitely have a role. But the mix has not been defined as to what's an appropriate mix that one can use to validly claim that you've got your net zero. And one of the challenges, of course, is that the duration of the storage is related to the climate effectiveness of that removal, effectively. And we're currently comparing these technologies on a dollar per ton basis. And unfortunately, that per ton denominator doesn't capture the durability aspect that's really important here. There's a few ways of trying to rectify that. One of the more ambitious sides is to take some inspiration from the electricity market designs. So typically when governments are running capacity market auctions, they would apply derating factors for different intermittent renewable capacity. And that would be one way of the renewable generators effectively being able to compete on a level playing field with the firm capacity. We could imagine a similar kind of scenario for removals, where one applies derating factors for anything that's deemed non-permanent. The question, of course, comes who comes up with the derating factors, and the issue that will never go away is what time horizon does one consider truly permanent, bearing in mind that CO2 stays in the atmosphere for tens to hundreds of thousands of years. So that will be challenging. The alternative, as proposed by Professor Miles Allen and co, is to treat these two systems completely separately and non-interchangeably. So the proposition there is to say that only biological sinks, so effectively temporary removals, should be used to neutralize biological emissions, and similarly only geological removals should be used to neutralize fossil emissions. So that would be the other extreme. And I suspect what we might see is some kind of middle ground. It's going to be really interesting to see what the UK decides on how to integrate removals into the ETS. One could imagine geological removals could potentially come in without a derating factor, potentially the inclusion of things with lower durability, particularly biochar, for instance, might come in with some kind of derating factor.
Great, thanks, Mostyn. Moving to the next question, just a question on the supply side. How quickly do you see the supply side ramping up? Are there enough projects out there in the pipeline today?
Well, yes and no. So we're anticipating that there'll be a really large ramp up. That's definitely not going to be sufficient to get to this, the gigaton scale that's really, scientists are saying, that's going to be required to, to hit those sort of 2-degree levels of warming. However, there was a recent study that was saying they're envisaging that supply could be in the region of 15 to 32 million tons by 2030. Under our assessment, that equates to, looking at the current named capacity projects, we feel that that's a bit pessimistic to say that no more projects will come online. We're seeing projects coming online, not online per se, but in the pipeline all the time. And so subsequently, we think that the volume could be more, closer to double that by 2030.
Great, thank you. And then another question that perhaps follows on from that one, and that's on balance, do we think permanent removals projects are investable today, or are there still barriers to before real money can flow into the sector?
Yeah, so they are definitely investable today, and the proof is in the pudding. Those early adopters are going ahead with these investments. They are aware that they are high risk, and they have ways of minimizing that risk, particularly through due diligence and de-risking. And over time, as more volume comes through, we're anticipating that it would develop in the same way that the corporate PPA market has developed, and eventually will go all the way through to some kind of standardized contracts, long-term offtake contracts.
Great, thanks, Mostyn. I think we're probably just about there on time. So thanks to the audience for the excellent questions. Thanks again, Mostyn, for the presentation. As I said, slides and recording of today's webinar will be available on our website shortly and emailed out to participants who joined today. And of course, get in touch with Mostyn or myself or anybody else from AFRY if you'd like to follow up on any of these discussions directly. Just a quick teaser for our next webinar. It's going to be on PPA markets in the Asia Pacific region. That's on the 19th of October. So anybody who's interested in that, please do sign up. And with that, I'll say thank you to Mostyn. Thank you to everybody for joining, and goodbye. Thank you.